Good morning. In this presentation, we will evaluate the quality of Euro Disney's accounting information in the years leading up to its delisting in 2017. We examine 5 areas of accounting judgment.
I'm Will, and I'll be looking at Euro Disney's revenue recognition.
Hi, I'm Rohan, and I will be looking at the impairment of assets.
Hi, I'm Aaron. I'll be looking at related party transactions.
Hi, my name is James, and I'll be talking about allowances for receivables and inventory.
Hi, I'm Charlie. I will be talking about PPE accounting. Euro Disney was the holding company behind Disneyland Paris, and it owned the core operating business responsible for theme parks, hotels, and the Disney Village retail complex. The group employed around 15,000 people and operated with a seasonal and capital-intensive business environment where both demand and cost structures fluctuated significantly throughout the year. Before the company was taken private, it faced sustained financial pressures, revenues moved unevenly, cash flows remained weak, and losses persisted for several years. What made Euro Disney particularly interesting from an accounting perspective was its heavy dependence on the Walt Disney Company. Disney was not just the majority shareholder, but also the company's only lender after the 2012 restructuring, and the provider of management services through an entity it fully controlled. Disney also held a representation on the supervisory board. This combination created a reporting environment where the parent company had influence over financing, governance, and operations. Because of that influence, Euro Disney's accounting policies and disclosures deserve closer scrutiny than in those of a typical listed company.
The first area which we are looking at is revenue recognition, and this is within the scope of IFRS 15. Euro Disney generated revenue from theme park tickets, hotel stays, food and beverage sales, merchandise, and special events. These services occur at different points in time, which mean management must determine precisely when performance obligations are satisfied. Under IFRS 15, revenue cannot be recognised simply when cash is received. It must reflect the delivery of the underlying service. A park ticket is recognised when a visitor enters the park. A hotel booking is recognised when the guest stays in the room. And merchandise and food and beverage is recognised at the point of sale. However, many of these services were paid for in advance. Guests could book hotels months ahead of buying multi-day tickets before their trip. While this is normal for a theme park business, it shifts significant discretion onto management because cash received early and must be held as deferred revenue until the service is delivered. Between 2014 and 2016, Euro Disney's deferred revenue rose from 10.8% to 11.7%. This indicates that a growing proportion of reported sales came from advance payments that had not yet been recognised as revenue. Although this reflects strong early bookings, it also increases the importance of judgment around the release of deferred revenue. This can affect reported performance, especially during periods of financial pressure. Euro Disney have been reporting losses for several years. In such an environment, the timing of revenue recognition becomes particularly sensitive. Even small changes to when multi-day passes or bookings spanning 2 reporting periods are recognised can influence how the performance appears to investors. While IFRS provides a clear framework, it still requires management to make decisions about performance obligations, allocations of transaction prices, and the treatment of breakage for unused tickets. For investors to understand the company's performance, Euro Disney needed more detailed disclosure about revenue recognition. This includes information on the composition of deferred revenue, how much related to parks versus hotels, and how policies were applied to bookings that extended across reporting dates. Without this transparency, it becomes difficult to assess whether increases in reported revenue are linked to genuine operational improvements, such as higher park attendance or hotel occupancy, or whether they reflect timing decisions. The red flag in this area is that deferred revenue increased during a period of ongoing losses. This creates a situation where judgment over timing could make a year-to-year performance appear smoother than it actually was.
So the second area we'll be looking at is the impairment of assets under IAS 36. So Euro Disney's had substantial long-lived assets including rides, attractions, hotels and infrastructure. And when indicators of decline exist, management is required to test these assets for impairment. In 2016, Euro Disney recorded a €565 million impairment charge, which management attributed this mainly to the decline in tourism following the Paris terrorist attacks. While this may have been contributed to the scale of the impairment stands out because the company had been underperforming for several years. Recognising such a large impairment in a single year suggests that early evaluations may have relied on optimistic cash flow projections or discount rates. IAS 36 gives management considerable flexibility. They must estimate future park attendance, hotel occupancy, pricing, operating margins and long-term growth. And they must choose discount rates that reflect the risk of cash-generating units. Small changes in these assumptions can produce large differences in the impairment outcome. When a company is reporting repeated losses, management may have incentives to delay impairment. A delayed impairment keeps assets values in higher and earlier periods and reduces depreciation charges. When the impairment is finally recognised, results in later periods can look stronger because the asset is being reset to a lower level. The timing is especially significant because Disney acquired full ownership of Euro Disney shortly after the impairment. If impairments were delayed, earlier shareholders may have relied on asset values that do not reflect the economic conditions. IAS 36 requires disclosure of the key assumptions used in impairment tests, including discount rates, growth projections, sensitivity analysis, and how cash-generating units were defined. Euro Disney's disclosures in these assets were limited. Without this information, investors cannot evaluate whether the impairment reflected genuine economic decline or a timing decision. The red flag here is that the combination of a single large impairment, years of underperformance, and the timing of the buyout. This pattern increases the risk that the impairment assumptions were not updated promptly, affecting the quality of the reported asset values.
The third major area concerns related party transactions under IAS 24. Euro Disney had an unusually extensive relationship with its parent company. Disney was its majority shareholder, its only lender, and the owner of the management company responsible for day-to-day operations. Many of Euro Disney's most important financial and operational arrangements occurred with the same counterparty. In 2016, royalties, management fees, service charges, and interest payments to Disney accounted for almost 13% of Euro Disney's revenue. When a related party controls both the pricing of services and the governance of the company, there is a risk that transactions may not reflect market terms. This risk is heightened because Euro Disney's management, including its CEO, was employed through Disney's management entity, limiting independence in negotiating terms. IAS 24 requires companies to disclose the nature of related party transactions, the pricing basis, and the governance processes used to review them. It also requires disclosure of compensation structures because incentives can influence management's willingness or ability to challenge the parent company. These disclosures are essential in analysing a business like Euro Disney, whose success factors depend on fair royalty rates, reasonable management fees, and sustainable financing terms. The incentives in this area are particularly important. During the years leading up to the buyout, Disney may have had an interest in presenting Euro Disney as less profitable, which could support a lower acquisition price. If related party charges were set above market rates, this would depress Euro Disney's profitability while increasing revenue for Disney. Without transparent disclosure, investors cannot assess whether losses were the result of operational challenges or of the pricing structure imposed by the parent company. The red flag here lies not only in the magnitude of related party transactions, but also in the governance environment. When the board lacks independence and key executives are employed by the related party, the risk that transactions are not negotiated on an arm's length basis increases substantially. Weak disclosures in the area reduce investors' ability to evaluate the fairness of the reported results.
The fourth area of interest is the estimation of allowances for receivables and inventory. These balances rely heavily on management judgment. Between 2014 and 2016, Euro Disney increased its allowance for doubtful receivables from 1.4% to 1.9%, but reduced its inventory for allowances from 8.9% to 8.3%. Opposite movements are unusual because both areas tend to reflect similar business conditions. If receivable allowances increase, it typically signals concerns about customer credit quality. If inventory allowances decrease, it implies lower expected losses on stock. Without a clear operational explanation, these movements are difficult to interpret. One possibility for this is earnings management. Increasing the receivable allowance reduces current profit, but creates reserves for future reversals. Reducing the inventory allowance increases current profit. Together, these adjustments can be used to smooth earnings. Euro Disney provided limited disclosure on the aging of receivables, write-off policies, and changes in estimation methods. Under IFRS, investors should be able to see how these allowances are determined and whether changes reflect underlying economic factors. Because merchandise sales and hotel operations are key success factors, transparency in these areas is critical. The red flag is the inconsistency between the two allowances. When such divergent movements occur without clear explanation, investors may question whether estimates reflect economic reality or reporting incentives. This weakens confidence in the reliability of margins and overall performance.
The final area is capitalisation of expenditure under IAS 16. Euro Disney incurred significant costs for maintenance, refurbishment, and new attractions. Management must decide whether each expenditure item should be expensed immediately or capitalised as an asset. In 2016, Euro Disney recorded a sharp increase in capital spending, while free cash flow fell from negative €65 million to negative €261 million. Some of this spending may represent genuine investment in improving the parks. However, it may also reflect decisions to capitalise costs that might previously have been expensed. When a company is already reporting losses, capitalising expenditure defers expense recognition and can make performance appear more stable. IAS 16 requires companies to disclose their capitalisation policy, the useful lives of assets, the depreciation methods applied, and the nature of significant capital projects. These disclosures allow investors to assess whether capitalisation is being applied consistently and appropriately. Euro Disney provided limited detail in these areas. For a business where physical assets drive attendance and guest experience, disclosure of capital expenditure is closely tied to the company's success factors. An additional point worth noting is that Euro Disney's workforce was large, and the company also exercised judgment under IAS 19 when estimating employee benefit obligations. These involve assumptions about unused leave, bonus provisions, and pension liabilities. Changes in these estimates can also influence the timing of expense recognition. The red flag in this area is the combination of rising capital expenditure, declining revenue, and the recognition of a large impairment in the same period. With several accounting decisions reduce immediate expenses, it raises questions about whether reported performance reflects underlying activity or the cumulative effect of classification choices.
To conclude, Euro Disney operated in an environment where accounting judgment played a significant role in determining reported performance. Persistent financial pressures, heavy reliance on Disney, and a complex web of operational and financing arrangements created incentives that could influence accounting decisions. In each of the 5 areas we examined, revenue recognition, asset impairment, related party transactions, allowances for receivables and inventory, and capitalisation of expenditure, we identified meaningful flexibility, clear incentives, and essential disclosures that were either limited or incomplete. These weaknesses reduced the transparency of the financial statements and increased information risk for investors. Although none of this implies wrongdoing, the pattern of decisions and the governance environment suggested that Euro Disney's reporting required a higher level of scepticism. Stronger disclosure aligned with IFRS requirements and with the company's key success factors would have provided investors with a clearer view of the economic reality. This is particularly important given the timing of the buyout and the implications for minority shareholders. If you have any questions about this presentation, please feel free to email one of the team. Thank you for listening.